They made billions. Some of them made trillions. Their logos are everywhere. Their names are global. Their influence shaped how the world works. And yet, even they run into serious tax problems. If you think tax issues are only for small businesses or individuals who made mistakes, this might surprise you. Because today we're talking about names everyone knows. Yes, they had tax problems too, and not small ones. Let's start with Apple, the most valuable company in the world. The iPhone, the App Store, an ecosystem that changed modern life. Trillions in market value, and at the same time, years of tax disputes with governments across the globe. For a long time, Apple made massive profits while paying very little tax outside the United States. Not because it was hiding money, not because it was breaking the law outright, but because it used extremely complex international structures that pushed income into low-tax jurisdictions. On paper, it worked for years, but here's the part people miss. When a company becomes that large, taxes stop being a private matter. They become political. Regulators started paying attention, governments asked questions, the public noticed. Eventually, pressure built to the point where the rules themselves changed. Apple faced fines, it faced regulatory scrutiny, and it had to restructure how it handled international taxes, not because it wasn't smart, but because no matter how sophisticated a tax strategy is, it only works while the rules allow it. And rules change when the stakes get high enough. The takeaway is simple: even the smartest and richest companies can't play tax game forever. At some point, scale removes flexibility. And if you're a business owner, investor, or founder watching this and you're scaling quickly, this is where attention matters. I'm Inna Volovik, an enrolled agent and founder of Solution 80/20. We work with growing businesses and high-income earners to make sure structured reporting and tax planning evolves before scrutiny does. If you want to know whether your current strategy still works at the level you're reaching, there's a next step linked below when you're ready, of course. Now, let's talk about Amazon, a company so large that most people interact with it almost daily. Online shopping, cloud computing, logistics, streaming. For years, Amazon grew at unbelievable pace. Revenue exploded, market share expanded, and its tax bill stayed surprisingly low. Not because the company was doing something illegal, but because losses and credits and reinvestment strategies legally offset taxable income. And for a long time, that was acceptable. But once Amazon reached a certain size, the narrative changed. The tax authorities stopped asking how the company was structured and started asking whether the outcome made sense. Once the company becomes too big, too visible, and too essential, tax authorities simply say enough. Audits increase, rules tighten, back taxes appear, new reporting requirements are introduced. The flexibility that existed during the growth phase disappears. Amazon didn't collapse, but it entered a new phase where taxes became unavoidable and unavoidable in public view. The lesson here matters for businesses of all sizes. The bigger you get, the less tax flexibility you're allowed. Growth buys opportunity, scale attracts scrutiny. Now let's move to Google. Search, YouTube, advertising, data. One of the most profitable companies in history. For years, Google used international tax structures to reduce how much it paid globally. Again, these strategies were legal at the time. They were well documented, they were advised by top professionals. But visibility changed everything. When a company becomes this dominant, its taxes become a public conversation. Governments started challenging the structure. Billion-dollar tax claims were issued. Court cases followed, regulators examined every move. At that level, tax planning is no longer just about compliance. It's about reputation. It's about public trust. It's about how much attention a company can afford to attract. And Google learned that every global company eventually learns. When you're this visible, your taxes are no longer private. They're part of your brand. Now let's shift from corporations to individuals. Lionel Messi, one of the greatest athletes of all times, a global icon, contracts worth tens of millions, endorsements, sponsorships, worldwide recognition, and still a criminal conviction. This case is important because it breaks a common myth. Messi wasn't poor, he wasn't reckless, he wasn't uneducated. He relied on structures, he relied on advisors, and those structures failed under scrutiny. The issue wasn't talent, it wasn't income. It was how the income was reported and where it was attributed. The result was fines, court proceedings, and a real sentence that damaged reputation as much as finances. The takeaway is uncomfortable but necessary. Fame does not protect you from taxes, and trusting structures blindly doesn't either. Now let's talk about Shakira, a global superstar. International tours, music streaming everywhere, multiple income streaming across countries, and at the same time, years of tax battles. Her case centered on one question: where does she live? And therefore, where should she pay taxes? This sounds simple, but for global individuals, it's one of the most dangerous tax issues that exists. Residency rules are strict, documentation matters, days spent in the country matters, intent matters, and when income is global, mistakes compound quickly. Shakira forced massive payments, years of pressure, and public reputation damage that no amount of success can fully erase. The lesson here is critical. The more global your income becomes, the more complex and dangerous taxes become. At that level, assumptions are expensive. Now, let's step back and look at what all these cases have in common. None of these companies or individuals became successful by accident. They were disciplined, they were strategic, they were driven, and still taxes caught up. Not because taxes are designed to punish success, but because success changes the rules. As income grows, expectations change. As visibility increases, scrutiny follows. As scale expands, tolerance shrinks. Taxes are not static. They evolve as your situation evolves. And the biggest mistake people make is assuming that what worked at one level will work at the next. For small businesses, for growing brands, for creators, for investors, the same pattern always appears. Growth happens first, planning comes later, and that gap becomes the risk. Here's the truth most people learn too late. You don't get into tax trouble because you failed. You get into tax trouble because you succeeded without adjusting your strategy. Taxes don't suddenly appear at the top. They were always there. They just became impossible to ignore. In the United States and worldwide, the question is not whether the tax issue will come. The question is when, and whether you'll be prepared when they do. The companies and individuals who survive long-term are not the ones who avoided taxes. They're the ones who plan early. They understand structure, they respect timing, they document everything, and they adopt as income grows. Because at certain level, taxes are not just a cost, they're a signal that you're entering a new phase, and that phase requires a different level of discipline. They made billions, and they still got hit by taxes. Not because they were careless, but because taxes always caught up. And the only real question is whether they caught you by surprise.